Welcome back to Compounding with Callie, where I take my dog Callie on runs and talk about anything investing, budgeting, and all things personal finance. So let's compound some miles and our money. One of the biggest questions new investors ask is, which portfolio should I use or follow? But the better question is, which portfolio fits my experience, my risk tolerance, and my ability to stay invested long term? Because investing isn't about picking the fanciest strategy. It's about picking one that you can stick with for decades. So today, let's break down 3 simple investing portfolios: a beginner portfolio, an intermediate, and an advanced. Each one slightly different. Each one with its own balanced effort, risk, and potential reward. And if you've never invested before, this framework makes things much easier to understand. So let's start with the simplest approach: the beginner portfolio. This is where many investors start, and honestly, where many investors can stay forever, because simplicity is incredibly powerful. Instead of trying to pick individual stocks or companies, instead of trying to predict winners, instead of constantly analyzing markets, you simply buy one fund. Something like VTI. VTI is an index fund that tracks the entire US stock market. And what that really means is you're buying exposure to the entire US market with one single purchase. Thousands of companies, large, mid-size, down to the small, technology firms, healthcare, manufacturers, retails, and even financial institutions, all bundled together. When you buy VTI, you're essentially saying, I want to own the overall economy. Not one company, not one sector, everything. And this is where things get really interesting, because people sometimes imagine index funds as static, like a frozen basket of stocks, but they're actually dynamic. They evolve. As companies grow, they naturally become larger portions of the fund. As companies decline, they slowly become smaller, sometimes disappearing entirely. No manual decisions required from you. No constant monitoring. The fund automatically adjusts. If a company becomes wildly successful, like Apple or Microsoft, its influence inside the fund increases. If a company struggles over time, its weight shrinks. This is investing on autopilot. You're not trying to guess the future. You're simply allowing the market itself to continuously rebalance your portfolio, which is why beginner portfolios require very little effort. You invest consistently, you stay patient, and you let time do the work. Now, naturally, some investors eventually want a bit more involvement, a bit more precision, maybe even a bit more potential upside. And that's where the intermediate portfolio comes in. Instead of owning just the entire market as one unit, you begin shaping exposure more deliberately. You might still own VTI, but you could also add or replace it with something like VOO, which focuses specifically on the S&P 500, the largest and most established companies in the US. These are the giants, the dominant global businesses, companies with massive revenues, global operations, and significant market influence. Then, maybe you add in a growth-focused fund like VUG, something tilted towards companies reinvesting heavily into expansion, firms prioritizing innovation, scaling, and long-term potential rather than immediate profits. And perhaps an international fund like VXUS, which gives you exposure to global companies, or a sector-specific fund like HACK for cybersecurity, which gives you exposure in a sector you may have a background in and feel confident in its future. This gives you more weight in certain sectors you feel will grow, but also more uncertainty. Now, suddenly your portfolio becomes more nuanced. You're not just owning the market, you're blending stability, growth, and higher risk opportunities. And this is where risk and reward starts shifting, because smaller companies can grow faster. Growth focused firms can deliver explosive returns, but volatility increases. Price swings become larger. Short term declines becomes more dramatic. This is the trade off: more potential upside, more emotional turbulence. Which brings us to the advanced portfolio. This is where investors introduce individual stocks, not replacing diversification, but complementing it. Imagine a portfolio that still holds diversified index funds, but allocates maybe 10 to 20% towards individual companies. This is where conviction enters the picture. This is where research, belief, and risk tolerance matter more, because individual stocks behave very differently from diversified funds. When you pick a winner, the outcomes can be extraordinary. Think about Nvidia. For years, it was just another semiconductor company. Today, it's central to AI infrastructure. Or Tesla, once dismissed as a niche electric car company, now a transformative force in automotive and energy. Early investors in companies like this saw life-changing returns. But here's the part many people overlook. For every Nvidia, for every Tesla, there are countless companies that didn't become massive successes. Take Verizon as a contrasting example. A stable, established business, reliable, predictable, but over long periods, its growth has been limited compared to high growth innovators. Not a failure, but not transformative. This is survivorship bias at work. We remember the spectacular winners, but we rarely remember the thousands of average or underperforming companies, which is why individual stock investing carries higher risk. Greater upside potential, but greater uncertainty, and certainly greater emotional stress. Because volatility, those ups and downs, are unavoidable across all the portfolios. Markets rise, markets fall, sometimes dramatically. And this is where behavior becomes more important than the math. Imagine opening your account during a market crash. Your portfolio is down 20, maybe 30%. Nothing fundamentally changed about your ownership. Nothing disappeared. But emotionally, it feels like a loss. This is where many investors make costly mistakes, trying to time the market, selling during declines, chasing whatever stock is currently popular, constantly changing their strategies. But long term investing works because volatility is temporary. Growth compounds over decades, not days. Which brings us back to compounding, the quiet engine behind wealth creation. Compounding is simply growth building on previous growth, returns generating more returns. At first, it feels slow, almost disappointingly slow. Early years barely seem noticeable, but over time, growth accelerates. Wealth curves upward. Most investment growth happens later, not earlier on, which feels counterintuitive, but mathematically, it's incredibly powerful. This is why consistency beats intensity. Small, repeated investments, long periods, and patience. Now, after understanding these portfolios, a very natural question emerges. What kind of outcome could these actually produce? Let's imagine someone graduating college and investing for 40 years. As an estimate, let's say a beginner style portfolio returns roughly 8% annually. The intermediate portfolio averaging maybe around 10%, and the advanced portfolio potentially reaching 12%. Those percentage differences sound small, but over decades they become enormous because compounding magnifies everything. The gap between 8 and 12% over 40 years isn't incremental, it's transformative. We're talking about a difference of 1.75 million, 2.6 million, and 4.7 million respectively for each portfolio when investing just $500 a month. Which highlights something incredibly important. Portfolio choice isn't just about returns. It's about matching strategy to personality, discipline, and life stage. Age plays a major role here. Younger investors have something incredibly valuable: time. Time absorbs volatility, time smooths downturns, and time allows higher risk tolerances. As investors grow older, priorities shift. Stability becomes more important, income generation matters more, tax efficiency becomes more critical, risk exposure often decreases. Strategies evolve. Investing isn't static, it adapts as life changes. And that's really the deeper lesson behind all of this. Investing isn't about finding one perfect portfolio, it's about understanding trade offs: effort versus simplicity, risk versus stability, volatility versus growth, and choosing a strategy you can stick with because ultimately, markets reward patience more than prediction, consistency more than brilliance, and discipline more than excitement. Investing isn't about getting rich quickly, it's about steadily building something that compounds quietly until one day it no longer feels quiet at all. And when you step back and look at all this, the real takeaway becomes surprisingly simple. There isn't one perfect portfolio. There's only the portfolio you can actually stick with. For some investors, that's the beginner approach: maximum simplicity, minimal effort, broad diversification. For others, they may want to step in the intermediate portfolio: a bit more shaping, a bit more volatility, a bit more potential upside. And for those comfortable with greater swings and deeper uncertainty, the advanced portfolio offers the possibility of outsized rewards, alongside outside risk. Because at the end of the day, investing isn't about chasing the highest possible return. It's about choosing a strategy that matches your personality, your comfort with uncertainty, and your ability to stay calm when markets inevitably fluctuate. The best portfolio isn't the most aggressive one or the most conservative one. It's the one that lets you sleep at night while still moving you towards your long term goals. And once you find that balance, that's when investing truly starts working in your favor. If this breakdown gave you a clearer path forward, hit that subscribe button. I'm here every week to help you cut through the noise and build a life of financial freedom. Thanks for tuning in. Same pace next time. Keep compounding.